What's up, world? My name is Michael EJ, bringing you more thoughts and insight in the world of finance, business, and life. Today, I actually would like to talk to you about this framework I've been using, this valuation theory I've been putting together for a while now, and even made past videos on it. And it's called the PVGO Framework. And I'm going to explain to you quickly how to use it for valuation, how I'm using it, and how you can take it and put it into practice today. Now, just a quick overview of everything. The PVGO stands for Present Value of Growth Opportunities. This is something that's already well known in financial theory, but rarely used to understand how much of a current stock price of a company is based off of what they're worth today versus what expected growth is going to be for that company tomorrow. So it's usually used at the extremes. For a very young company, you expect it to be above 90%, PVGO that is. For a very old company, you expect PVGO to be around 10%. Very simple. Young company, lots of growth, that's the stock price. Older company, the growth is almost non-existent, so it's what you see today. Pure and simple. But there's a wide range in between that I believe that PVGO can also be used for, and is underutilized by the finance community, and can really provide some interesting insight into what is being priced within a stock. Now, just a quick run through the whole equation. It's based off of three main components. The first is the economic benefit. Most people would use earnings per share. I would prefer to use net operating profits after taxes, because I tend to look at companies at a firm level instead of just an equity level. Discount rate is self-explanatory. You can use CAPM, WACC. Some people got a build-up model, historical returns, whatever's your flavor. And then growth expectations. That's where PVGO percentage comes in. And you can use past trends, the potential size of a company, current stage of the company, competitive analysis, reinvestment rates. And since I'm talking about those key things, PVGO is best used when connected to a company in their life cycle. I mean, that's kind of the whole purpose of it. Like I mentioned before, young company, high PVGO percentage. Older, mature company, lower PVGO percentage. That's the expectation. Now, the first two stages of a company, mainly in their startup phase, it's very hard to use this system. I'll admit that, because it's based off of you kind of need a positive number to work with when using this PVGO percentage. And if you don't have a positive number, i.e. no profitability, like I can't even finesse the numbers to get you there, then I'm sorry, I can't use it for you. So venture capitalists, you guys are still trying to figure things out. Now, once a company can kind of see profitability and they become public, that's when we're talking. That's when this can be used. And usually that point comes, like I mentioned before, when that company decides to go public. Institutional investors don't want to hear about revenue growth nearly as much. They want to see the potential for profits. They want to see, are they going to be rewarded maybe in the long run by dividends, stock buybacks? Are you going to get rid of the debt holders, not worry about them so much? So, yeah, the best way to represent this is the graph to your right. Once you get more into just a high growth phase where revenue still matters a lot, but there's at least some profitability there, that's when the PVGO percentage start kicking in. And one thing to keep in mind is that although a company can grow in terms of profits and can become less risky over time, they can still be worth the same amount over time. Like a company can grow as large as it wants, it can still be valued at the same number. In theory, if that company growth and profits is matched with less growth opportunities. So it's just something to keep in mind. And one reason why I like this system so much is you can grow all you want, but if it's not the right type of growth, and if you just keep losing opportunities as you grow, then I'm sorry, buddy, your value is not growing. So let's define this framework a little bit more. So I usually place a company in different buckets. So 75 to 100%, 50 to 75%, 25 to 50, and 0 to 25%. Now, at the top bucket is where you expect these younger companies to go. This is where Snapchat would be. It's all about the revenue growth. Extremely high reinvestment rates. That's the whole point of going public. You need to go public because you kind of need the cash, and the private markets are essentially done with you. It's probably not that harsh, but that's kind of the flavor. So it's all about high reinvestment rates. That's expected. A lot of your value as a company is from what you expect to do in the long-term future. Move down the list. Revenue growth is still matters, but it's not as high. Reinvestment rates are still very high, but they're approaching 100%, as in you're approaching the level where you generate enough cash to cover your own investments. And in this area, I'd see Tesla right here, in this 50 to 75% range. Once you cross over that 50% range, that 50% range is kind of like stepping stones, a milestone. You now generate enough cash to kind of cover your own investments. And that's when investors start to change their mind. Now they're not focused on how much growth you have. Now it's, what are you getting with all those investments? Well, how much returns are you getting with those investments? Returns on invested capital matters much more. Revenue growth is more in line with industry, so you don't have revenue growth to lean on anymore. Now it's, how profitable are you? And this is where I see Starbucks, maybe a Google's at. They still have really good revenue growth, but it's all about how profitable they are. They have a lot of investments in the ground, so what's your return on those investments? And then you get to a point where, you got little, no, maybe even negative revenue growth. You're as big as you can be, and things are starting to calm down. You might even divest a couple of assets. This is where I see Walmart and McDonald's at. They're just so large that they're just too big. They have to kind of calm down. And the only time they really have a relatively high reinvestment rate is if they're buying another company. So in that aspect, I expect more of the growth, at least in returns, to come maybe more from dividends and buybacks, since there's essentially no more growth opportunities there. Now, just to show how important this percentage is to a company's value, put together a graph here showing an implied growth rate and a PVGO multiple based on that percentage. And as you can see, the closer you are to 100%, the more it affects your value. Even the difference between 90 and 95% is essentially, are you worth $200 or $100? Double the value. And it's very important. That's why it's very tough to value earlier stage companies, because you just don't know. When you're older and more mature, you can see it, but younger, not so much. But still, very useful to see where you expect the company to be, maybe in the next 3, 5, 10 years. So, I already showed you how I at least section off all these companies based off their, where I think they are in the corporate life cycle, which is mainly based off of two things in my opinion: revenue growth and reinvestment rates. Now, how do I determine exactly where you're going to be? For a Google, for example, which I say it's in that 25 to 50% range. When valuing them, am I going to choose 30 or 40%? What kind of sways me either way? To me, it is all about, once again, how much are you reinvesting, but more importantly, are those investments leading to a greater competitive advantage and greater quality growth? Now, those two things are connected, and it's based off of return on invested capital. So are you investing in assets that will lead to a higher return on invested capital in the further out future for a younger company, or in the near term future for an older company? Best way to do that is invest in intangible assets, something almost never talked about, usually not touched upon, but that's where competitive advantages usually stem from. They come from the intellectual property you have. They come from the list of a backlog you have relative to maybe other companies in your industry. It comes from software, technology. It comes from a well-known brand. All these things matter, And if you break down the return on invested capital equation, your advantage usually comes from either the consumer side, which means higher margins, or it comes from the producer side, which means higher asset turnover. So I want to understand that a little bit more. And the more you invest in those areas and more you're getting results out of those areas, the higher I expect your PVGO percentage to be. The more expectations I have, and should be rewarded for that. Now, with all that said, let's do a little bit of an exercise here. Looking at the S&P 500 just in general. Just over the past 25 years, really since 1990, just trying to understand where things have been. Took all these numbers from Aswath the Motorin, and just to sum them up, essentially a discount rate, cost of equity between 8 to 9% is usually where the market's at, and more importantly, PVGO percentage is usually between 30 and 40%, meaning about 60% of the value, 65% of the value you can see today, and 35% of the value is what you can see tomorrow. That's at least baked in to the stock price. So with that said, where's the S&P 500 now? So let's just play with this a little bit. Trailing 12 months earnings per share is about $116. We're just going to use the 8% cost of equity. I'm just going to run with that for right now to simplify this. And for the PVGO percentage, first we need to find the no growth expectations. The expected value if no growth was ever there. So you take 116, you divide it by the discount rate of 8%, and you get $1,455. That's the no growth value of the S&P today. Now, S&P is at 2,343. So the no growth value actually represents approximately 62% of the market price today, meaning 38% of the market price is what is expected upon growth tomorrow in the next upcoming years. Now, based on this analysis, the market is actually still relatively fairly valued. Getting close to an overvaluation, getting close, but still relatively fairly valued, which is different than a lot of pundits out there. It's different than a lot of analysts out there who think the market's in a bubble, it's overheated, you can't find, there's no opportunities out there. I believe that's bogus. I believe there's plenty of opportunities out there. Because remember, S&P 500 is made up of 500 plus companies, and it's a weighted average. So there has to be some companies that are below, and there has to be some companies that are above. Now, depending on where they are in their life cycle, you can still find some opportunities out there. Now, to take it a little bit further, let's just throw some other things in consideration. In my opinion, the S&P 500 and the market in general has a inverse relationship with the bond markets, and more specifically the Fed funds rate. When it's cheap to borrow money, it's cheap to get bonds and cheap to get loans, then yeah, a lot more companies are willing to invest. As soon as the costs to borrow start to rise, then companies are a little bit more weary. They don't want to borrow as much, or not even borrow at all. So essentially, based on that relationship and the yield curve flattening, that's scary, because that's saying the long-term prospects aren't as clear. Based on those two things, I'm not looking as optimistic on the market right now. Although some people may differ, I'm not as optimistic. So just a slight dip is what I may expect. And because of that, I would actually choose a PVGO percentage of 35%. I think that's more of a better estimate of where the market should be today, of its actual value. So if you look at my estimate for value, take that estimated PVGO, and you actually create what I would call a PVGO multiple. So that's actually 1 divided by 1 minus your expected PVGO percentage, what you think is the actual present value of growth opportunities, and you get a multiple out of that. You take that multiple, in this example, it's approximately 1.5 times, multiply that by the no growth value of whatever stock or company you're looking at, and in this instance, it's the S&P 500, and then you get an estimated market value of the company. So for the S&P 500, I think the market value is actually closer to 2,240, which is approximately 5% cheaper, like less than where it's at now. So, I mean, in my estimation, I actually do think the market's slightly overvalued, so I actually do lean a little bit more with the pundits. But it's not too wild. It's not too extreme. I would still make a lot of investments today, especially if you go back to a couple of those slides and you look at when markets actually dipped relative to where the S&P usually is at. You'll see that the market can stay overvalued for a while before correction actually comes. So that shall do it. I mean, that's essentially it. This framework that I'm putting together coincides directly with the corporate life cycle of a company. So you have to really understand a company in and out and business cycles and business stages before really using this system. And it can be viewed two ways. You can see where the market's at and implied growth opportunities is, as well as you can see for yourself where you think they can be and make adjustments accordingly. So that should do it on this video. The next couple of videos, I'm going to actually be applying this to different stocks that I'm interested in, what's hot in the market, just give my take on where valuation should and shouldn't be. And if this is your first time coming across this channel, I mean, finance is my passion. It's where my heart is at, and I will always talk about it. I also talk about things related to business in general, also trying to connect with professionals out there, especially young professionals like myself in their mid to late 20s, early 30s, and just share different opinions about what's going on in the world today. So with that in mind, thank you so much, and until the next time, peace.